The broadcast is now starting. All attendees are in listen-only mode.
Welcome everyone to Nova 401k Associates webinar, Introduction to 401k Plans for Plan Sponsors with Charlene DeMartini and Christine Hall. Before we get started, I would like to point out the panel on the top right-hand corner of your screen. You will see a drop-down section for questions. This is where you will enter in any questions you may have for Charlene and Christine, and they will answer as many questions as time permits. Please be sure to make your questions as descriptive as possible, and we will be answering questions during the Q&A portion at the end of the webinar. If time runs out and you still have questions, please send them to our email address, webinars@nova401k.com. Right below questions, you will see the handouts drop down. Here you will be able to download today's material. If you are with us today to earn continued education credits, please be sure to stay until the end to fill out our survey. This will allow us to track your time and participation. Certificates will be sent out within a week for those who met the time requirements. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you for joining us today. I would now like to introduce from Nova's Defined Contribution Administration team, Charlene DeMartini and Christine Hall.
Well, welcome everyone. We're going to be talking about introduction to 401k plans for plan sponsors. So I'm going to assume a lot of you that are listening in have a brand new 401k plan. Congratulations on that. It's a great benefit for both your employees and you. But there's a lot to learn about 401k plans. So that's what we're going to do today in this presentation. We do have some housekeeping to do before we get started. Here's our disclaimer. Please note that the information in this presentation is general in nature and not intended to be a substitute for legal or tax advice. Please consult a qualified professional, such as an attorney or an accountant, if you need legal or tax advice. And if you want to get CPA credit for watching this webinar, as I know some of you that are out there are wanting to get CE credit, and if it's for CPA, Nova's provider number is 009820. Be sure to register individually. You need to be present for the entire webinar and complete the evaluation form at the end, and you'll receive your certificate for CE credits within 1 week. All right, we have a big agenda today, so we're going to jump right into it. Just to give you an overview here, we're going to talk about the roles and responsibilities in a 401k plan, Nova's cybersecurity measures, 401k basics, the moving pieces in a 401k plan, distribution basics, loan basics, and then finally end things with our annual calendar so that you know what to expect during the year. All right, so there's 4 different people, entities that make up your 401k plans administration roles. We're going to start with you, the plan sponsor. As plan sponsor, you have the overall fiduciary responsibilities for the plan. You're responsible for communicating the plan to your employees. You're also responsible for remitting those employee contributions to the plan. And you're responsible to provide data to the third-party administrator, that would be Nova, on an annual basis. The next person beside that is the plan's financial advisor, and that is often called the plan's broker. And they're going to assist the plan sponsor to select funds that the participants can choose to invest in. They're going to coordinate enrollment meetings with the plan sponsor and different types of employee education. Their role is going to be to help you to get employees interested in the plan so that they're participating well. in the plan, and they're going to assist you so that you can remain 404C compliant. And that's so that you have a good fund menu with lots of options for your lots of appropriate options. It may not always be a lot, but appropriate options for your plan participants to invest in. And then going right down below plan sponsor, we have investment provider, and that is often called the record keeper. That's the custodian. That's where your plan assets are held. So when you're making those payroll contribution deposits, that's where you're making them to, the record keeper. So they invest the plan contributions. They provide daily record keeping. You know, they'll have a website where your participants can log on to see their account value on a daily basis. And they will also process distribution withdrawal request and provide the participants with a quarterly statement. That's often mailed to their house, but in today's electronic world, oftentimes participants have the option to choose to receive an electronic statement. All that comes from the record keeper. And then finally, you have your third-party administrator, or your TPA. That's Nova 401k Associates. And our role in your plan is really to keep your plan in compliance with the law. We prepare and maintain the plan document. And as you'll find out later, the plan document is the written rule book for your plan. So it's important that what that plan document says is how you want your plan to run. We complete the required annual compliance testing for your plan, and we prepare annual filings, the Form 5500 for your plan. And we'll talk about that too coming up. And we provide ongoing plan consulting for you. You know, like I said, we want to make sure that your plan's set up, that it's meeting your needs and how you expect your plan to be running. So, you know, we want to have those ongoing conversations with you. And if you ever have questions about your plan, you want to reach out to your account manager who's on the plan. All right. Well, before we jump into more of the 401k nitty-gritty, I do want to make sure that you all have a comfort level with Nova's cybersecurity measures. It's just so important nowadays that we keep things safe. With 401k plans, there's a lot of money in 401k plans, you know, and unfortunately, the bad guys, as we quote it, they know that, and they know it's a way that they can do bad things, you know, to steal money. You know, they will try to coordinate attacks on the record keeper where your money's held. That could start with a phishing attack or a hack on one of your employees' emails. The attackers would then contact the record keeper, you know, reset the employee's password, and with the new password, the attackers can request loans and distributions. We want to try to prevent that from happening. So ACHs and wires are typically only discovered when there's trivial amounts, and you know, when it's discovered when it's trivial amounts, it's recovered. But when it's a large amount, unfortunately, that's usually when it's not recovered. So we need to be diligent about things so that those kind of things don't happen. You know, and I'm sure that you've went over even with your employees about, you know, how to be careful when emails come in and things like that. This type of theft from plans is, unfortunately, it's not covered by the plan's fidelity bond or fiduciary insurance or E&O insurance. So we all have to be alert and do our part to prevent fraudsters from succeeding. So one of the things that you're going to be asked to do on an annual basis is to send your annual census information to Nova. And those files contain a lot of confidential information, like social security numbers, dates of birth, people's addresses, their compensation for the year. So we want to make sure that that is sent to us securely. That information is then we use to do testing, and we put together non-discrimination testing files that also have that information in. So again, we need to be careful with how we get those reports to you. We would never just send those reports to you through an email that's not secure. Sometimes too, we need to get certain tax forms from you, like W-2s or K-1s or Schedule Cs. And again, I put, we never ever want to send them through a regular email without encryption. And in fact, Nova has a secure file exchange that we use that's even more secure than an encrypted email. We have a secure web portal through our plan sponsor link, and the address is right there. And if you'll notice at the bottom of all your account manager's email, there should always be a link to our plan sponsor link there to help you to get there. That's really what you want to use to transmit that kind of sensitive data to Nova, and that's how we will send it back to you. We'll post things on our plan sponsor link. Okay. Nova does have encryption software. Before we would add any new plan contact to our plan sponsor link, we want to be sure that that person is legitimate, and we'll ask for authorization from an existing contact before we add them to our system. Also at Nova, all employees have mandatory training every quarter to make sure that we're doing our due diligence and being careful with your sensitive data. We also have a password policy at Nova where passwords need to be changed at least every 90 days. So we're really doing our part to keep your sensitive information as secure as possible. I'd strongly encourage you to use our secure web portal to send us that information to, rather than through a regular email. Again, and I went right into this slide, use our plan sponsor link to submit the annual census data to Nova, use the secure file transfer feature on our website, limit the number of people that you copy on emails, and then also make sure that when you're setting up passwords that you use a complex password and change it often. Then you can be doing your part to help us to protect your data. All right, so now that you feel a little bit more secure about our cybersecurity, we'll jump right into the 401k basics. 401k plans are so popular because they give employees an opportunity to save for retirement on a pre-tax basis. It's really set up to be easy for employees. It's not meant to be complicated for them. We want them to fill out an enrollment form, or set up their account on the record keeper's website, decide how they want to be invested in the plan and at what rate they want to contribute to the plan. And then it's really supposed to just happen for them. Really 401ks are, for many people, their biggest asset outside of their home. So it's just a really important benefit for most employees. And it's their primary source of retirement income. Now, even though things are tried to be kept easy for employees, 401k plans are very heavily regulated. So it's not as easy, from a plan sponsor point of view. The IRS has regulations on 401k plans, and so does the Department of Labor. And some of their regulations are not always common sense. So when you think, oh, that would make sense for a 401k plan to run that way, that's not always the case. Plus, government rules change frequently, as we know. So there's a lot to keep up with your 401k plan. That's how NOVA wants to help you out to make sure your plan stays in compliance. And then, like I said earlier, you need to have a written plan document for your plan, and that's really what runs your plan. If it's not in your plan document, the rule does not exist for your plan. So looking at the IRS first, how they relate to 401k plans, you need to be in compliance with the federal statute and the IRS regulations. They require annual non-discrimination testing, which NOVA will do that testing for you after we get your annual census data. They define when taxable events can occur and the deduction limits for the year, and that can change on an annual basis. They expect your plan document to be amended timely, and the IRS usually requires all plan documents to be restated around every 6 years, and that's an IRS requirement. And they want, like I said, your plan document to be followed, because if the IRS were to audit your plan, the first thing they're going to want to see is that plan document and the adoption agreement that goes along with it. Then we have the Department of Labor, and the Department of Labor is more concerned with how the plan is running for the employees. They want to make sure that the employees' contributions are and their loan repayments are being deposited in a timely manner. They want to make sure that those funds that you're offering participants to invest in, that it's a good lineup and that they're prudent choices, and that the expenses that are being charged to participants' accounts to run the plan are reasonable. And then each year, the Form 5500, which is the annual reporting, needs to be submitted to the Department of Labor. Now, earlier I said sometimes the rules that the IRS or the Department of Labor have aren't common sense. So I have a couple examples of that. As a plan sponsor, you might think that it makes sense to be able to exclude your hourly employees from contributing to the 401k plan. And you can certainly do that, but that has to be written in the plan document, in the plan's adoption agreement. You can't just assume, oh, well, it doesn't count for the certain type of employees. You are able to exclude certain employees from the plan as long as the testing passes, because that does require additional testing. But as long as the testing passes, you are allowed to do that, but it has to be written in that plan document. Another example would be, what is the preferred investment alternative for an employee who puts money into the 401k plan but fails to make an investment selection? So you have someone that signs up for the plan, doesn't make an investment choice, or maybe they aren't making 401k contributions, but you're giving a profit sharing contribution for the year, and the person never made an election. Where does that money go? Well, several years ago now, the answer was, it might make as it makes common sense to some people, this would go into a money market or a stable value fund, which wouldn't have much change in its value. That would be similar to a savings type account. However, the Department of Labor said, no, that's not going to work, because if that person would leave their money in the money market fund for years and years and years, they're not going to be keeping up with inflation. So their rule is for that type of default fund. It needs to be a balanced fund or a life cycle fund, so that it is a fund that's more moving with how the market's moving, and providing those participants who never made a fund election, to be able to get a return similar to what the market's doing at that time. Now, I did bring up before about having timely deposits of 401k contributions and loan repayments. This is really important. The Department of Labor looks at these kind of things. They even ask about it on that annual reporting, the Form 5500. And they have rules split up for two different sizes of plans, if you will. First is the rule for small plans. And your plan's considered a small plan, generally if there's under 100 people in the plan. And the rule for that, for small plans, is that the 401k contributions and loan repayments need to be deposited into the plan's account, into that record keeper's account, within 7 business days after the pay date. So if you get paid on Friday, 7 business days from that Friday, it needs to go in. Now, honestly, truly, the best way to do this is to have making deposits into your plan part of your payroll process. The Department of Labor loves to see it as part of your payroll process. And so, having that consistency, so if you get paid on Friday, maybe it always goes in on the following Monday or Tuesday. Department of Labor loves to see that, and that'll be easier for you to keep track of things too if you keep it part of your payroll process. Now, for larger plans, and that is a plan that has more than 100 participants, the Department of Labor gets a little bit tighter on their rules. Their first rule is they want to see it go into the participant's account as soon as administratively possible. Now, there's an older rule that said that the contributions need to be deposited by the 15th business day after the following month. And it's still kind of hanging out there, but this, as soon as administratively possible, trumps that rule. If the Department of Labor audits your plan, they're never going to be happy about, bringing up, oh, but it was within the 15 business days of the month following. That's an old rule. They're not really looking at that. They're looking as soon as administratively possible, and they really want to see those contributions go in within 3 to 5 business days after the pay date. Again, have it be part of your payroll process, and that's going to be the best way to make sure that the contributions are going in timely. Right below that, it says it's a huge issue in Department of Labor audits. Yes, they look at this. They look for consistency. Sometimes if they see consistency, even if they see, an outlier that's still within that 7 business days, they'll still say, well, that was late because you've been doing it like on the 2nd business day. Love consistency. So the more you can do that through your payroll, as part of your payroll process, the better. It's also an issue if you have a large plan for your annual plan audit that's done by a CPA. Again, they're looking out for you in case your plan would be audited by the Department of Labor. So they look, for that too, that the deposits were made timely. Then I've been talking about this Form 5500 being submitted to the Department of Labor. So what that is, it's an annual report for your plan. It has to be electronically filed. They won't take it any other way but electronically. And the information that's on the Form 5500 is at the plan level. So there's no information about any particular participants. And the Form 5500s are actually publicly available on the Department of Labor's website. And this is because it's not giving any specific participant information. It includes participant counts on it, certain fees that are paid by the plan's income statement, and the plan's financial statement. And each year, NOVA will prepare that Form 5500 for you for filing, so that all you'll need to do is do a quick review of it to make sure it seems reasonable, and then electronically file it. One of the things on the 5500 is also the plan's fidelity bond. That's asked on there. And all plans are required to have a fidelity bond. And if your plan is a large plan, you are required to have an independent audit by a CPA. Again, a large plan is a plan that has more than 100 participants, but there are some transition rules, so that if your plan's kind of hovering around that 100 point, the IRS allows you to have up to, if you're a small plan, and you're allowed to have up to 120 participants in the plan before the plan will then change to a large plan and require an audit. That way you have some knowledge of that it's coming. All right, so I had mentioned the importance of getting those contributions in in a timely manner, making it part of your payroll process, and that kind of brings us to payroll integration. You know, what is it? It's when your payroll provider submits full census data each pay period directly to the record keeper. And the census data is going to include addresses, dates of birth, dates of hire, dates of termination, compensation, deferral data, you know, anything that record keeper would need to communicate to the participants too. And it's going to include all employees, regardless of whether or not they defer. That way, if they decide to start up with the plan, that record keeper already has that information. And why would it be helpful to use payroll integration? Well, your annual census data could possibly be easily pulled from the record keeper, and NOVA needs to get that annual census data from you, and we'll request that through our plan sponsor link after the end of each year. When the record keeper is updated on a payroll basis, it also allows them to more quickly process distribution requests that participants may have, and it allows them to have automatic distributions to participants, because once they receive a determination date in a census file, the vendor will send distribution packets to the participant. If the account's under $5,000, in most cases, the participant's account can be forced out without notice after they've had 30 to 45 days to make a decision. That's beneficial, because then small accounts won't stay hanging around in your plan. Sometimes when that happens over time, it might even be difficult to locate a former employee, and so it prevents that from happening. Keeps your plan clean so that you don't have small terminated employees' accounts hanging around. Having the census data also allows the vendor to keep track of enrollment. So once your employees' data is received, the vendor can send enrollment packets to participants when they become eligible for the plan. And if your plan has automatic enrollment, it also helps with that. And with sending out statements, and they'll have that address change also. And if any former employees are rehired, they'll be updated right away to know that they can start participating in the plan again. So there's two different types of payroll integration. It can work two different ways. The most comprehensive way is called Payroll 360, and that's when census data goes both ways. So it means your payroll provider is going to send census data to the record keeper, and also the record keeper is going to send changes that participants may have made, like to their deferral amounts, back to your payroll provider. So that's a nice setup because they're communicating back and forth. And if your payroll provider and your record keeper have that setup available, you know, that's something that you really might want to look into, because it would be your most hands-off way of having the census data communicated. Another option is payroll 180, and that would be where it's just going one way. It's going from your payroll provider to the record keeper. And then any changes that would happen at the record keeper, you know, you would still have to communicate back to the payroll provider for those deferral changes. Okay, so the reason why census information is so important is because it gives us what we need to do the non-discrimination testing for your plan. The first test I want to talk about is called ADP testing, and that's average deferral percentage. That's what that ADP stands for. And that compares the deferral amounts of highly compensated employees, and we'll get into how that's defined, how you determine if someone's highly compensated. It compares their amount that they're deferring to the non-highly compensated employees. And usually the comparison will end up being that on average, your highly compensated employees can contribute 2% more than your non-highly compensated employees on average, and the test will pass. If there's failures, refunds are needed to those highly compensated employees to bring things back to where there's no more than that 2% difference on average. So who are the highly compensated employees? Well, for 2022, we always need to look back at the prior year when we're determining highly compensated employees. So anyone who earned at least $130,000 during 2021 is a highly compensated employee. Anyone who had greater than 5% ownership in the company, regardless of what their compensation was, so even if their compensation was under that 130, anyone who had greater than 5% ownership is a highly compensated employee. And anyone who's a lineal family member or spouse to a direct 5% owner that's working for the company is also a highly compensated employee because of that owner attributions. So that's how we know who's highly compensated. Another non-discrimination test that we need to do is called top-heavy testing. And what top-heavy testing does, it looks at what's called key employees. And key employees are a little bit different than highly compensated employees. We'll look into what a key employee is. But key employees, if their assets in the plan are more than 60% of the total plan balances, then the plan is considered top-heavy. Now, for top-heavy, if participants have made rollovers into the plan from another plan, that is excluded for top-heavy purposes. But any contributions that were deposited into this plan and not rollovers, that's going to be taken into consideration when determining that 60% of assets. So what is a key employee? Well, similar to highly compensated employee, anyone who's greater than a 5% owner is considered a key employee. And if you're a lineal family member of that 5% owner, you're also considered a key employee. But here's where it gets a little bit different. For key employees, if you're a 1% owner and you make greater than $150,000, then you are a key employee. Or if you're an officer and you make greater than $185,000, then you're a key employee. So some of the information that we ask on an annual basis when we do that census request is, who are the owners in the company? who are the officers, and the reason, and we also ask about family members that work for the company. The reason we do that is so that we can determine who are the highly compensated employees and who are the key employees to do our testing for your plan. So for some companies, when you hear about that ADP testing and you hear about that top-heavy testing, you might already be thinking, I don't think my plan's going to pass. There is a solution for that. That's called a safe harbor plan. And safe harbor plans are exempt from those two tests. So I want to talk about that a little bit because perhaps you might already have a safe harbor plan and want to understand a little bit more about what that is. So there's two types of safe harbor plans. You can have a safe harbor plan by having a special match. The basic matching formula requirement for a safe harbor plan is 100% of the first 3% of deferrals made by an employee plus 50% of the next 2% contributed. So basically what that means is if an employee contributes at least 5% to the plan, they're going to receive a 4% match. The other option for safe harbor plans is what's called a non-elective contribution. And that is a non-match contribution. It is independent on what the employee decides to defer to the plan. When you have a non-elective contribution, it just looks at who's eligible for the plan, regardless of whether or not they contribute. And if they're eligible for the plan, they're going to get a 3% of pay contribution. In both cases, the safe harbor match and the safe harbor non-elective contributions are 100% vested. So that means no matter how many years of service your employee has, if they receive a safe harbor matching contribution or safe harbor non-elective contribution, that is 100% theirs when their employment ends. Now there are some additional non-discrimination testing, and these apply even if your plan is a safe harbor plan. One is coverage testing, and that's making sure that if you do exclude certain types of employees, like I said earlier, if you exclude hourly employees, we need to do testing to make sure that that is not discriminating. And whenever we do non-discrimination testing, we're always comparing your highly compensated employees to your non-highly compensated employees. If you decide to make a profit sharing contribution to the plan, there's non-discrimination testing that goes along with that to make sure that your profit sharing allocations are within the IRS regulations. And then there's compensation testing. So if you want to exclude a certain type of compensation from the plan, let's say you don't want to include bonuses as plan eligible compensation, you can do that, but then additional testing is required. Okay, I can't stress enough that it's important that your plan documents amended timely. Plan documents have to be amended from time to time to stay current with new legislation and or IRS regulations. And the amendments need to be executed timely. So when you get information from NOVA, it's usually going to be through a DocuSign that you need to review and electronically sign a plan amendment. You don't want to ignore that and put that on the back burner. You know, that's something that's important for you to look at right away so that the amendments are put in place timely. And because there are penalties for failure to execute timely amendments. Your plan document, in the adoption agreement, it's going to explain the terms of your plan. It's going to define the eligibility requirements for your plan. You know, which employees are going to be eligible and what requirements they have to meet to be eligible. when they can enter the plan, what the plan compensation is, how the employer contributions are allocated, and what your plan vesting schedule is. And there's more information in that adoption agreement, but these are your top 5 things that get used the most. Now, sometimes when we take over a plan, we will see that there are errors that were made, and these are common errors that are made that you want to look out for. So, excluding bonuses from deferral elections. If your plan doesn't allow for that, you don't want to be excluding them. You know, you need to make sure it's in your plan document if you're excluding bonuses from deferral elections, excluding part-time employees from the plan. In most cases, you can't exclude part-time employees from the plan unless they're working under 1,000 hours per year. And that needs to be, you know, written in your plan if a certain group of employees are being excluded. Matching catch-ups matching catch-ups separately from non-catch-up contributions. So most plans will allow catch-up contributions. These are additional 401k contributions that can be made by employees that are at least age 50. For this year, employees that are at least age 50 can contribute up to $6,500 extra as a catch-up contribution, and you don't want to match that separately. You want to include all of that as 401k contributions when doing the calculation. Similarly, matching Roth contributions separately from pre-tax contributions. You want to include any deferrals that employees make, whether they're Roth or non-Roth or catch-up, all added together when calculating the match. They should not be calculated separately. Not distributing the summary plan description. That is a big error, and the Department of Labor really doesn't like that one. The summary plan description is a layman's term description of your plan document and adoption agreement, and that needs to go out to employees. So when you want to make it part of your practice that when an employee becomes eligible for the plan, that you are giving them a copy of that summary plan description. Another error is not allowing new employees to participate in the plan. You want to make sure you know the rules of your plan as far as when employees become eligible, so that you're allowing all employees to come into the plan when they meet those requirements. And then not capping matching contributions based on the annual compensation cap. And we'll show an example of that too. Okay, so a couple examples. Let me just pause here, get a sip of water. Okay, so not allowing participants to enroll on time. So ABC's company plan has no age or service requirement. So we call that immediate eligibility. So the plan has immediate eligibility, but it doesn't offer Steve enrollment in their 401k plan for 6 months. Okay, so who knows what happened in that situation, but Steve wasn't treated fairly according to the rules of the plan. So when that happens, it can be corrected, but ABC company is going to have to make Steve whole by making an employer contribution for his missed deferrals and also an employer match. So you want to try to avoid that if possible, because that can be, an unexpected cost to your company for that error. All right, and then not properly capping the matching contributions. So what does that mean? So for 2022, the most compensation that can be considered for 401k plans is $305,000. So in this example, the plan's matching formula is 50% on the first 6% of employee contributions. When that's the case, then the maximum match that anyone can receive in this plan with that formula is $9,150. And the way I got that was multiplying the pay cap, that $305,000, times the 50% times the 6% to get $9,150. That's really important. And if your plan's matching formula may not be that 50% on the first 6%, if you have a different formula and you're not sure how to calculate that maximum match, reach out to your account manager. We're glad to help you out with that because it makes things easier if you don't go over in the match, and you know where that cap is. Okay, initial eligibility into the plan. So the IRS allows at maximum a waiting period of 1 year and age 21 with a minimum of 2 entry dates. So after you wait for a year and you're age 21, you can get in on 2 entry dates. You can have anything less than that the IRS would allow. A certain number of hours can be required for that 1 year of service, but you cannot exceed more than 1,000 hours with that requirement. And the age, like I said, can't exceed 21. The initial computation period is 12-month anniversary from the date of rehire. And then after that, if you didn't meet that 1,000-hour requirement or whatever the hour requirement is for your plan, then it typically changes to the plan year. We'll look at an example that's a little bit easier to understand that. So on this example, if we have an employee that was hired earlier this year on June 1st, 2022, and we want to figure out when they're going to be eligible for the plan. Again, for this example, we're assuming that they need to have a year of service, which is a year in which they work at least 1,000 hours to be able to get into the plan. So the first computation period is looking from their date of hire to 1 year after their date of hire, which is June 1st, 2023. So if they worked 1,000 hours during that time period, they would get in on the next plan entry date, which is the semi-annual date, which would be July 1st, 2023. Your semi-annual entry dates, if you have a calendar year plan, are January 1st and July 1st. Now, let's say during their first year employment, maybe they were, part-time, pretty limited. They didn't work at least 1,000 hours, but then right at the beginning of the next year, they switched to full-time. So the next computation period is going to be looking at January 1st, 2023 through December 31st, 2023. And if the employee worked at least 1,000 hours during that time, he or she will get in on the next entry date, which will be January 1st, 2024. And if they didn't, you're always going to be looking at the calendar year to see if they worked 1,000 hours. And if they do, they get in on that next January 1st. Now, one of the complicated situations with plans can be dealing with rehires, how to know how to handle that. So if a formerly eligible employee ever had a single vested dollar in the plan, so it means they met the eligibility requirements, they had money in the plan, even if they took a distribution of the plan, but at one point they had money in the plan, then they never lose their prior service credits. If they're rehired, they get right back in the plan upon their date of rehire. If that's not the case, otherwise, they lose their prior service credits after 5 consecutive one-year breaks in service. So if they didn't meet plan eligibility requirements and they never had money in the plan, if there's 5 breaks in service, 5 years that they didn't work, then they lose their prior service. Allow rehires who have not lost their prior credits to participate in the plan immediately upon their date of rehire. That's important. Rehire situations can get confusing. So if you have a rehire and you're not sure whether he or she should be in the plan, reach out to your account manager for help with that one. We'll be glad to help out. And next, we're going to talk about moving pieces, and I'm going to turn it over to Charlene.
Thanks, Christine. Just give us a second to show our different screens here. Can you see that, Christine?
Can you make it to where it's the
I think it's on your.
Yeah.
Hold on. Where's that little drop down? I'm not seeing that little pop-up that was supposed to come up.
If not, it's okay. You can just scroll. We can view it this way and just scroll down to the next
Okay,
page.
sounds good. Okay. Okay, everyone, we're going to get into the moving pieces of the retirement plan and who is responsible for what pieces. So this is a similar slide than what Christine went over earlier, showing the different components of the plan, the record keeper, the TPA, and the investment advisor, and just showing you what duties each are responsible for. The record keeper maintains the portfolio of investments, the investment transactions, the reporting, and education and communication of the different funds. The TPA, which is Nova's part, again, we will complete the compliance testing and consulting, which Christine went over some of that compliance testing. We will help you with the optimal plan design and drafting of the plan document. So at any time, if your plan document and plan design is not working for what you intended, let us know and we can go over some other design possibilities. We can assist with the distribution and loan transactions, and we're going to go over some of those transactions in a minute. And the government reporting and disclosures, as Christine mentioned, the government return 5,500 is required each year, and we will provide a draft of that 5,500. We'll go over an annual calendar so you know when to expect that information to come to you. And then also you have your investment advisor or broker, which will maintain the client relationship with yourself and also consult with you on the different funds offered in the plan, as well as communicate those to participants to help them be able to select what is prudent for their situation. They will conduct an annual review of the plan. They will go over the fees that have been assessed for your plan, make sure that all the parties involved are appropriate for your plan and your plan size. They will also go over the funds and how they performed for the year and offer any suggestions if you need to switch a fund out at any time. And then, of course, as we already covered, the enrollment opportunities with the participants to help them get enrolled and select funds that are appropriate for them. So again, just a couple of moving pieces to who's responsible for what and how it gets done. The first here is how does the money, I'm sorry?
I'm sorry to interrupt. I don't think that your slides are showing on the screen.
Okay. Are you seeing any of my screen?
I am, but I'm seeing attribution rules.
Ah, okay, so you're seeing a different screen for some reason. Let's just do this.
There it is. Thank you all for being patient.
Everyone.
I have two screens up too, everyone, and until as soon as Charlene moved it, I'm like, no, it's not moving right. So apologize for that on that last slide if that was a little confusing, but I think we're good.
Okay, so we'll just go back real quick to this slide. Thanks, Christine.
Sure.
This is the slide that we were looking at, going over the different responsibilities for the plan, and then moving on to the moving pieces of how things get provided or work in the plan. This is how the money gets to the record keeper. Your record keeper, there's lots that we work with, so it could be John Hancock, Voya, Empower. There's lots of record keepers out there that will fit the needs of your particular plan. Most of those record keepers have a secure website for which you will be able to upload your contribution information. Typically, you can have a spreadsheet that includes the participant's name, the source of money that's being deposited, and you can upload that to the record keeper site. The record keeper then tracks the money by source of money. So on that spreadsheet, you're going to provide whether it's a deferral, safe harbor contribution, match contribution, Roth contribution, any of those items that apply for that payroll. Upload that, and your record keeper will track that by source of money. And when you get your participant statements, we'll show those deposits into those particular sources of money. Who calculates the employer matching contributions? This will depend on how often you want to deposit your match. If you want to deposit the match payroll by payroll, which is very popular with plan sponsors, because participants typically want to see that money going into their plan if they're due a match and they're deferring. And if that's the case, typically it's going to be either the payroll company, or if you're doing payroll in-house, you'll be calculating those amounts payroll by payroll and uploading those to your record keeper. If you need any help in calculating those match contributions, we do have some spreadsheets that are available that will help you enter the data and calculate the match each pay period. Just let us know, or your plan account manager, and they can help you with those spreadsheets. If you'd rather just have an annual match, so you're only depositing once a year, that's typically calculated by Nova. So when we receive the annual census data that Christine had mentioned earlier that you'll upload to our secure web portal, once we get that annual census data, we can calculate the match for you, and we'll provide a spreadsheet of the participant name and the amount of money to be deposited for that participant's match. And you can use that spreadsheet to upload to your record keeper. Who's responsible for preparing the 5,500? If you remember, Christine mentioned that there's a 5,500 an annual government return that's required each year. Unless it's a special engagement, Nova will be preparing that 5,500 for you. We prepare a draft of that 5,500. If you're a small plan filer under 100 participants, you can review that filing and ask us any questions and sign that electronically and submit it. If you are an audited plan, that audited plan is going to require an independent audit, and so that financial report will be attached to the 5,500. So we'll provide a draft to you, and that will also go to your auditor, and you both can review that and let us know if you have any questions or changes. And then once that audit report is received, that can be uploaded to the 5,500 as well, and then signed and submitted. Next, how does an employee get distribution paperwork upon termination of employment? Of course, typically participants are very anxious to get their money out of the plan once they're terminated. So we first suggest that you give the employee the information with your COBRA notices or part of their exit interviews so that they can have that paperwork ready and complete it while they're thinking about all the other paperwork and get that processed. Upon request, we can mail that information to employees, but we found that it's pretty easy, and you can track when that information was provided to participants if it's given to them with their other paperwork. Who's responsible for distributing required notices? There are quite a few notices that can be required for a plan. Some are dependent on the provisions that you have in the plan, and some are for every plan. The first is the summary plan description, the SPD, and that's required for every plan. The summary plan description is more of a layman's term booklet that details the provisions that are in your plan documents. The summary annual report, which is the SAR, that is a summary of your 5,500 that needs to be distributed to participants. It's all on a plan level basis, so nothing that's detailed by participant. It would just show the total distributions for the year, the total earnings for the year, total contributions. All of that data that's reported on the 5,500 is in typically a 2-sheet information summary that is provided to the participants. A special tax notice. The special tax notice details the tax implications if a participant takes a distribution. So in this case, if a distribution is requested, the participant typically has federal withholding, and it will detail that data. But typically the special tax notice is going to be included in the record keeper's distribution notices as part of that distribution form. So a lot of times it's not a separate notice that has to be distributed and can be part of the distribution form. So you may have already distributed it without knowing that you're distributing it. But if it's not part of the record keeper form, you'll want to make sure that you do have a separate special tax notice to give to participants. The next is the annual safe harbor notice. As Christine mentioned, that there are several different formulas that you can have to make your plan a safe harbor. Part of the safe harbor regulations is that the notice announcing that safe harbor formula must be distributed each year. And that notice is required to be distributed with no later than 30 days prior to the effective date. So if you are safe harbor for 2023, that notice will need to be distributed no later than December 1st of 2022. The next is the annual 404A5 fee disclosure notices. And this is a notice that details the fees that are paid by the participants either from the funds that they've selected, or if they have a distribution or a loan processing. These are typically part of your record keeper functions. So just check with your particular record keeper to see if they are distributing those notices for you. That's required for each retirement plan, regardless of what provisions you have. And the last one we have listed here is the annual automatic enrollment notice. You can have what's called an automatic enrollment plan, where rather than a participant opting into the plan, as most of the cases of the plans where a participant will need to fill out an enrollment form and submit it if they want to defer into the plan. An auto enrollment plan is an opt-out plan. So unless the participant tells you they do not want to participate, they will automatically be enrolled at a certain percentage that you have selected in the plan. And if you do have that automatic enrollment feature, then there is another annual notice that's required each year as well. And typically a plan will distribute that with the safe harbor notice so that you can have everything bundled into one packet. We do have a sister company that's able to handle those notices for you each year. If you have a smaller plan population, maybe not so difficult to distribute those notices. But if you have a lot of participants and you're going to incur larger administrative fees for one of your staff members to prepare all these mailings and send them out to participants, here is a contact for AFS that can help you with those notices. They will take the notices and provide you with a packet to review. And once that's approved, they will distribute to all of your plan participants that are eligible for the plan. So it's a really good service that we have quite a few clients taking advantage of, simply because there's maybe too many employees to have one person on your staff sit and do mailings all day long. Now we're going to get into some distribution basics and then some loan basics of how money gets out of the plan. Once money goes into the retirement plan, it's subject to rules of when it can leave. The intention on a retirement plan is just that, so that it can save money for participants when they retire. Therefore, the regulations are strict on when a participant can take that money out of the plan. But they do want, the IRS and DOL do want to offer different options, because a lot of people have different reasons that they need access to that money. And if participants don't know that they have access to that money in case of some kind of hardship that they're incurring, they may not be willing to participate in the plan. So there are options available. Several options that we're going to talk about are termination of employment or retirement from your company, age 59 and a half distributions, which are also called in-service distributions, hardship distributions, and death or disability. So for termination of employment, again, I had mentioned that you may want to distribute their distribution forms to them when they are there for your exit interview with all your other notices like COBRA notices. And the forms can be submitted prior to an employee's termination date. If they're leaving next week and you want to go ahead and give them their forms this week, they can be submitted, but the funds are not going to be withdrawn until their last day worked. Also, on the record keeper form, you may notice that they ask for when the last deposit or contribution deposit is being made. That's just so that they can ensure that there's not one straggling contribution that's going to be deposited after the distribution is processed, so that all the distribution can be done at once. Also, again, you'll need to provide that tax notice. So make sure that if it's not included in the distribution paperwork, that there's a separate tax notice that you are distributing. Next is age 59 and a half or in-service withdrawals. So this is a discretionary provision that you can have in the plan. You're not required to have it in the plan, but most clients do prefer that it be in the plan to give participants the option if they need it. It's an in-service withdrawal, so it means that participants need to be employed to take this distribution, and they cannot start taking in-service withdrawals until after age 59 and a half. And the main reason for this provision is so that your employees can start making preparations for their retirement while they're still working. So they may have a financial advisor that they work with on a personal level, and they may want to start moving some of those funds to that financial advisor. Maybe they have different fund options that are more suited for them for retirement, or just part of their whole planning that they have being set up by that financial advisor. They'll want to take some of that money. With age 59 and a half, it's important to remember that a participant can still make deferrals into the plan. This is just giving them the availability to take some of that money out of their plan, but they can still defer into the plan. They're still employed and still an eligible employee. Next, we have hardship withdrawals. Again, this is a discretionary provision that you may have in your plan, and this is still widely used. It's not as widely used as the in-service withdrawals, but it's still widely used by plans. And what this does is it allows a participant to take out money from their plan for certain hardship reasons. There are hardship reasons that are written into the regulations, which we'll go through. And if you meet one of those criteria by showing documentation that you meet one of those criteria, then you can take out the amount of money to satisfy that need. It's still generally subject to the 10% early withdrawal tax. So you need to be careful on those participants that they understand that they're going to be taxed on that withdrawal, and they're also probably going to incur a 10% early withdrawal tax. For the age 59 and a half, let's go back to that slide. Age 59 and a half, typically you do not have the 10% early withdrawal penalty. That typically goes away at age 59 and a half. So that's why 59 and a half was selected for this in-service withdrawal option. The reasons for a hardship withdrawal are listed here: purchase of a principal residence, prevent eviction from a home, unreimbursed medical expenses, post-secondary education, casualty losses, and burial expenses. Some of these are also available for dependents of the participant. And so you can see that it's very specific in the hardship that they would have documentation for. But in case they have one of these situations for themselves or their dependent, it gives them access to that money in those circumstances. In addition, having this specific listing of a hardship takes you as the plan sponsor out of the scenario of having to decide who has a hardship and who doesn't. It's very specific by the guidelines and the regulations of why you can take one. And so you don't have to, like I said, police whether or not one person has the hardship or one person doesn't. It's very specific as to why they can take this money, and they are providing documentation of these expenses. There are some new rules as of 2019. So if you had a plan at your prior company or at your company now, there may have been provisions that were different. The first is that you used to have to take a loan if offered by the plan before you could take a hardship. That is no longer the requirement. You can take a hardship without having to take a loan. You no longer have to stop contributing to the 401k. Previously, there was a provision that a participant needed to stop deferring into the plan for at least 6 months. And these first two were mainly in the regulation because the government, I guess, felt that if you couldn't afford, if you needed a hardship in order to afford one of the expense reasons, then you're probably not able to repay a loan repayment or make deferrals into the plan. So there were some provisions that were previously there for that purpose, but have now been taken out of the regulations. Investment earnings on deferrals were not available previously. They are now available for withdrawal. Employer contributions may be available. You can elect to have employer contributions available for hardship distributions, but you don't have to. So you can have hardship distributions in the plan and only allow the participants' 401k deferrals to be withdrawn. You don't have to elect your safe harbor, your match, or your profit sharing to be withdrawn. Also, safe harbor contributions previously were not allowed. It wasn't discretionary to allow or not to allow. Now they are available, and you can elect that in your document. If you want to know what your provisions are for the hardship, and maybe you previously were not electing safe harbor, you can change your plan document provisions to now allow safe harbor. So if you want to tweak any of those hardship withdrawal options, just let your account manager know. The next reason for a distribution would be the unfortunate death of a participant. The funds are distributed according to the participant beneficiary election. It's really important to have an election on file for each of those participants. Typically, that is held by you as the plan sponsor. The participant will fill out an election form, and you can put that in their personnel file. But it's important to have that beneficiary election for the participant so that you know how to distribute that money. If there's not a beneficiary on file, there is a hierarchy of who that money will go to, but oftentimes it's not the person, maybe the participant wanted it to go to. So if the participant wants it to go to someone specific, we'll have to have that beneficiary election on file. One of the provisions, married participants have to have a spousal consent to name a beneficiary other than their spouse. If you don't name if you name a beneficiary other than your spouse, but you don't have that spousal consent, it will not be allowable. So it's important that if a beneficiary is other than your spouse, that you have that spousal consent. If you don't have a beneficiary form on file, that benefit will be paid to the spouse automatically. As I said, there's a hierarchy of who the money will be distributed to if there's not a beneficiary election on file. The first I mentioned will be the spouse, then it will be the children, then it will go to the parents, and then it will go to the estate. So there's 4 different hierarchies for who that money will go to, and hopefully you don't have to get to that situation because hopefully there's a beneficiary election on file. Next is age 72 distribution. And up until, I guess, about a year ago, these were age 70.5 distributions. So if you had a participant who had turned 70.5 and was terminated previously, they need to still take distributions under the 70.5 regulations, but any new distributions will be under age 72. So beginning in the year that an employee turns age 72, they must begin taking money out of the plan. The caveat to that is that for an employee that is not a highly compensated employee, Christine went over with you the definition of a highly compensated employee. If you're not a highly compensated employee and you've turned 72, you're not required to take these distributions until you terminate employment. However, if you're a highly compensated employee, so you are an HCE, and you've turned 72, you need to start taking these withdrawals regardless if you're active or terminated. So that's the distinction in the age 72, whether or not you're a non-highly or highly compensated employee, and whether you're terminated or active. So again, here it's just reiterating that if you are a non-owner employee, so a non-HCE, you may delay taking those distributions until you're age 72 and have terminated. Quadros is another distribution that occurs, and that's a qualified domestic relations order. Typically, it comes up in the context of a divorce. It could be for several other scenarios, maybe involving children and other scenarios that are available, but typically it's in a divorce. And what it is, it's a domestic relations order that is essentially splitting up the portion of the account balance that is to be distributed to the ex-spouse. There are lots of regulations around the quadros, and there are specific requirements in order for that domestic relations order to be considered qualified. And so if you do receive one of these domestic relations order, until it's been deemed that it has all the appropriate information, it's not considered qualified yet. And so you'll want to reach out to your account manager and provide that to the domestic relations order to them so that we can review the domestic relations order, make sure it has all the information, and then we will provide the distribution forms to the particular parties that are involved so that we can have that money split into 2 accounts, the participant and the ex-spouse, and then the ex-spouse can take a distribution once those monies are distributed into the separate account. Spousal consent. Most plans do not require spousal consent. It's pretty rare that I see any spousal consent anymore. It used to be that if you had an old money purchase pension plan, that you needed to get spousal consent. A lot of those money purchase plans have gone away, and you're just having profit sharing plans now. So that's why it's typically not seen. But if you do have old money purchase pension plan money in the plan, then you'll need to be getting spousal consent. Extremely important to have that spousal consent for distribution. that is $5,000. So again, most of the time you're not going to have spousal consent required, but you do have to watch for these odd situations that you may have specific money source that requires that spousal consent. For loans in the plan, loans are not required. Again, they are discretionary to have it in the plan. But again, loans are popular with participants because it allows participants access to their money if they need to. And it's a pretty decent benefit for them because they are paying themselves back. They will be assessed an appropriate interest rate, which is typically 2% over prime. That's written into the plan document. But at least they're able to borrow from the money from the plan, pay that back through payroll deduction, and it goes back into the plan. So they're not charged the 10% early withdrawal penalty, and they don't have to show documentation for a hardship. So it's an available option for the participant to take money and pay it back to their account. There are rules for taking a loan. The first is the participant cannot borrow more than the lesser of 50% of their vested account balance, or the highest loan they will ever be able to have is $50,000, and that will be reduced by any outstanding balances during the last 12 months. You can require only or allow only one loan at a time, and if that's the case, then of course you wouldn't have this reduction. But you can offer more than one loan, but it's very popular to only have one loan. Plan sponsors just don't want to make this a savings account. They want to be able to save for retirement for their participants, and the way to do that is to limit the availability for these loans. So having one gives an option to have a loan, but then doesn't have continual withdrawals from the plan for loans. The plan also needs to provide a minimum loan of $1,000. And since the participant can only borrow 50% of their vested account balance, they would need to have at least $2,000 in their plan to be able to take a $1,000 loan. Other rules, as I mentioned, a reasonable interest rate, which we've deemed to be 2% over prime. They must be repaid within 5 years unless it's for a residential mortgage loan. If they are taking a loan for like a down payment on their principal residence, they can take that loan for up to 20 years. But typically you'll see loans within 5 years time period because they're being used for other purposes. As I said, loans are paid through payroll deduction. They can have the final payment paid out of separately than payroll to pay it off, but all other payments will go through payroll deduction. Lastly, the loans become due upon termination of employment. So if a participant doesn't have payroll deductions, a payroll option available anymore, that loan is due. And so they can have the option of paying that loan off and then taking a distribution from the plan, or they can not pay off the balance of the loan and have that loan taxable. So they'll receive a 1099 at the end of that year showing what the outstanding loan balance was that they did not repay. It doesn't count against someone's credit to have that default of a loan. It's just a taxable situation. There are fees for requesting a loan. There will be typically a loan initiation fee, and also there may be annual or monthly maintenance fees, and you'll need to check with your record keeper about those fees. Participants typically bear the cost for the loan, so this isn't something that the plan sponsor needs to pay for them, and so that's why it's typically used by plan sponsors. Lastly, we just have here the fastest way to get a loan is to apply online if the record keeper offers online requests, and also to request an ACH debit rather than a paper check, so they won't be having to wait for the Postal Service to deliver that check. So the last part of our presentation is to go through an annual calendar. I know we only have a few minutes left, so I will highlight a few of these options Some of them are repetitive, just based on what the eligibility that you have for your plan. So I won't go through each of those, but we'll go through a few here. The first is 1099s distributed by the record keeper no later than January 31st. So again, if a participant has a defaulted loan, they're going to receive a 1099. In addition, 1099s are assessed for any refunds that are due because of testing failures or a distribution that a participant took, whether it went to an IRA or was taken in cash. They will all receive a 1099. In January is when we start asking for census data. So as Christine mentioned, we'll request that census data in January, and then you'll upload that census data to our secure web portal. Participants will be receiving their fourth quarter statements from the record keepers. And this is what's going to be repetitive on each of these months, is the entry date for your plan. If your plan has semi-annual, quarterly, or monthly entry dates, then January is going to be one of those dates, and you're going to have to provide enrollment materials. February, again, you're going to be submitting that census data if you didn't already do so in January. NOVA will be working on the annual compliance testing to try and get that completed by March 15th. Over here in the March column, we have that the March 15th is a big deadline for the failed ADP or ACP testing refunds. If you don't have a safe harbor, you may have some of those refunds that are due by March 15th. In April is the first deadline for the age 72 and age 72 distribution. So we'll calculate those for you in typically October, but those first withdrawals are due for participants by April 15th. April is also the due date for excess 402G refunds. The 402G refund is the limit that you've gone over for the annual limit for deferrals. In this case, we had plan year 2020 listed here. $19,500 was the annual amount that you could defer, plus $6,500 if you were age 50 or older. If you went over those limits, you may be due a 402G refund, and that would need to be processed by April without penalty. In May, we're going to start working on that government return that we mentioned, the Form 5500. Again, June, we're going to continue working on that audit as well. July 31st is the due date of the Form 5500. If you are not filing an extension, it is due on July 31st. Typically, if you have an audited plan over 100 participants, those typically go on extension, and that due date will be October 15th. Let's see. Summary annual report, we went over the notices that are due to participants. The summary annual report is that two-page sheet that describes the 5500 reporting detail. That would need to be reported to, or distributed to participants rather, by July 31st. I'm sorry, by September 30th, if you had a due date of July 31st for the 5500. So if you're not on extension to October, then September is your due date for that summary annual return. Let's see. Again, I mentioned the due date for the 5500. If you go on extension, the fully extended due date is October 15th. It is really, really super important to have that 5500 filed by October 15th. That is the last deadline for 5500s, and 5500 penalties for late filing are substantial. They are assessed by the IRS and the Department of Labor and can be up to $100 a day. So it's very important, and if you're not filing by October 15th, you will probably be getting a notification from us probably weekly to say it's really important to get us your data because October 15th is the last due date. Let's see, safe harbor notices. We went over the notices that need to be distributed by December 1st. That would include your safe harbor notice, your default investment notice, and auto enrollment notices. So if you have any of those, make sure they're distributed by December 1st. Let's see, summary annual report. If you had an extended 5,500, your deadline is going to be December for distributing that summary annual report. December 31st is frequently the deadline to execute IRS amendments. We need to make sure that all plan documents and amendments are signed by December 31st. And those age 72 distributions must be processed no later than December 31st to not incur a penalty. That is the end of our presentation. We do have a full schedule of webinars on our website. So here's the link to look those up for any future webinars that we have. And then I think, Yvette, you're going to go over the CPA credit.
Yeah, so make sure once this we close out this webinar that you stay for the survey to pop up and fill that out just so that we can track who will be needing a certificate. We don't have any questions right now, so if you want to go ahead and we'll go ahead and close out the webinar. If you do have any questions, go ahead and email us at webinars@nova401k.com, or you can go ahead and email Charlene or Christine directly. We have their email addresses up on the screen. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or you can visit us at our website, which is www.nova401k.com/webinars. And again, if you wanted to go ahead and get today's handouts, it's on your panel. You can just click the little drop down to handouts. But that is about it. Thank you so much, Charlene and Christine, for your time today. And thank you again to everyone for joining us. We hope you enjoy the rest of your day. Bye.